Welcome out to another Trading Justice podcast. I'm here with my brother Matt. This is Mark. We are the Justice Brothers from Tackle Trading. Tackle Trading is an amazing trading platform, educational based, application focused. We do our best to create a fantastic community. And we've had a lot of people along the way join that community, and they're just absolutely the best part of it. TackleTrading.com. You can sign up for a 15-day free trial, get the newsletter, the traders report, all of the goodies. Matt, how are you doing? And just give me 10, 15 seconds on how awesome Tackle is.
Oh, Tackle is amazing. You're definitely going to enjoy it. So definitely go over there to TackleTrading.com, sign up for a free trial membership, and enjoy all the goodies that we like to give our pros.
You know, one of those goodies is the newsletter that we put out every weekend. And Matt, it was funny talking to you yesterday as you were preparing to write the technical and the other pieces of the newsletter you did. And you were like, so we're going to do a trilogy, are we? Trilogy on the same topic, but that's what's called. We had a hot unemployment report on Friday. We'll talk about some of those good news is bad news vibes that you talked about coming off what was another week of stronger economic data with some inflationary undertones along the way. But Matt, in the big picture, we're kind of in the same spot we were 3 weeks ago, which is why I had to deal with a sarcastic brother yesterday all day long.
Little bit sarcastic on the trilogy series of the Tale of Two Time Frames here, but again, that's kind of what consolidation brings. It's a very similar story. Throughout the consolidation period, people get excited on the bulls as it starts working up to resistance. Bears start getting excited as it starts working towards down support. And at the end of the day, you really haven't seen it necessarily. I mean, there's a few behavioral changes on the bear side of the equation that is, given the Bears control going into next week a little bit. But in general, where we were at in the newsletter 3 weeks ago is, all right, guys, we're trying to figure out where this next trend is. Too many conversations in the market happen about the next trade when, quite frankly, this is all about the next trend and where that next trend develops. And so 3 weeks ago, that the pivot points in the market were 580 by 600, 580 support, 600 resistance. That was kind of the tale of two time frames last week. And things changed a little bit this week because as the consolidation is set forth, the average price is coming down a little bit, bringing down those shorter duration moving averages to really converge against a couple other levels that are important. 594 is a little bit more important today than it was, say, a week ago. That's right where the cluster of shorter duration moving averages kind of rest its weary head right now. And so you look at 594, you look at 600, but at the end of the day, we're still dancing the 580 by 600 level. And on Friday, Mark, the labor market came out and had a very robust number. I'm sure we'll talk about it here in just a second. And the market responded very aggressively to the downside. It was like a falling knife. And yet, what occurred? Support held. The buyers stepped in a little bit, and again, bears still have control, but you still have that same type of conversation. At the end of the day, I feel we're already in correction territory, and I do believe this is about finding a bottom in the market. But there is concerning technical data coming into the week. There's no doubt about that.
And let's do a little education econ 101 lesson on good news is bad news, Matt. Mm-hmm. One of the interesting things when a new trader, and I remember this, comes into the market is that we have in our heads associated. And I remember this because I remember the mindset. I think most people do because it's a contrarian thinking that has to occur. Whereas good economic data is good for, markets, and bad economic data is bad for markets, right? This very, one for one equation. And yet in markets, in reality, that's not the case at times where good news is sometimes bad news. Expand upon this, teach maybe new traders, what that's all about.
Good news is bad news is a theme that occurs in the market, and it's been a theme in the market ever since the subprime meltdown, when the Fed became the ultimate impact of all price action. And ever since then, there are environments that we enter into that is known as good news is bad news. And good news is bad news is when good economic data is seen by the market as a negative, i.e., you get good economic data, good for America, good for people, good for the US economy, good for so many different reasons. But you know what it's not good for? The market that only cares about interest rates and growth. And so when you talk about the economy and the market, the stock market is not a 1-to-1 ratio against the U.S. economy. If the U.S. economy is going up, it doesn't mean the market's going up. If the U.S. economy is going down, it doesn't mean the market's going down. Oftentimes that's the case, but it's not all the time. When you're thinking about the overall business cycle, for example, and you have this 8-9 year business cycle, average is right around 7 to 8 years, but we've had expanded business cycles really over the last 20 years. And so when you think about the business cycle, you have different phases in the business cycle. You have the growth phase of the business cycle where the Fed is lowering interest rates and they're trying to spark growth. And when the Fed is attempting to spark growth, good news is good news. Good economic data is really good for the market. The Fed is trying to spark growth. They're trying to encourage growth. And so when we see good economic data in that environment and the Fed is participating in that, it's like, oh my goodness, that's really, really, really good. Good news is therefore just good news. In environments where you have pauses in the market from a monetary perspective in the business cycle, good news is not necessarily always good news because it's really about understanding what the market wants to see and what the Fed is doing. Is the Fed trying to spark growth? Is the Fed trying to corral growth? Is the Fed worried about inflation? Are they fighting inflation? Or are they opening up the floodgates? And so in an environment where the Fed is concerned about inflation, they're concerned about the economy getting too hot because of inflation, and the interest rate conversation, meaning the path of policy, is uncertain, the market's not going to celebrate good economic news because the chief concern is inflation. And when the chief concern is inflation, good economic data has a tendency to elevate inflation. And so it becomes good news as bad news because good economic data also brings into that additional worry, elevated inflation. And in this specific environment, it's a little bit more aggressive given the fact that I think for a lot of the market, maybe not you and I are a little bit different on the inflationary conversation, but for the most of the market, Wall Street even, I kind of believe that they thought that the war was over.
Yes, no, I think that is what has set the stage for what's going on in this environment, right? That it was over, that and the Fed had communicated many times in the last 16, 17 months. They took a month off in like March or April last year where they're like, we're going to be cautious for a month. But, other than that, the communication was this battle is over.
For months and months and months. And that wasn't us here. We've always felt the last journey to 2% was going to be extremely difficult. And what Janet Yellen and the Fed did with opening up the floodgates of monetary policy. Yeah, they were conservative with the interest rate mark, but the interest rate is only one aspect of monetary policy, quite frankly. And Janet Yellen and obviously Powell, they did open up the floodgates a little bit early last year. And quite frankly, it was most likely because of the election, but we don't have to really kind of debate that right now. The simple reality is they did give up that fight against inflation to a certain extent. The market, Wall Street, had declared victory a little bit on the inflationary side of the equation. And now that we're facing down the barrel at that 3% number, which, Mark, how long ago did I say this was going to happen? Like how many, not months, not weeks, how many years ago did I say 3% was going to be the ultimate sticky number to the point where they're probably going to give up the 2% goal? How many years ago did I tell you?
I can't even remember. It's been so long.
It was like second day during the pandemic when inflation started hit. They were flooding the market with money, and they made the announcement that they were going to open up their soft target on the 2% to 2.5%. And I started chuckling and I said, Chucky, that ain't going to happen. They're going to lock it at 3% after all this is said and done. because if you understand how inflation works, there's no easy solution to this. You have to allow all the money to work through the system, and that takes a lot of time, quite frankly. And so the market was probably ready to move on, and the market was probably ready just to embrace a growth stage of the market where they're not fighting the Fed. And so now that they do have to fight the Fed in the short term, the market's throwing a little bit of temper tantrum, trying to understand the uncertainty of the environment.
Yeah, and we're going to talk about this a little bit more in the bull versus bear. We're going to do a little segment where I take the bear side, Matt takes the bull side, kind of talk about it. And Matt, we're having, genuine discussions in the market. You see it on the chart, right? Even if you did not know anything that was going on in the backdrop, but you were just a technician. Let's say you just lived in a bubble and you just looked at charts. You're like, oh, the market's debating something. Right? The market's debating something right now. And if you were in your little bubble, you'd be like, I don't know what that is, but the market's having a debate. And so we're going to highlight some of that bull bear debate here in a second. But Matt, the market hasn't been getting a reprieve really on the economic data. When I think back of the last couple months of economic data, Matt, I can remember one PCE inflationary report that missed, right? And maybe a couple little things here and there. But Matt, it's been a lot of strong data. It's been some worrisome, not panic inflationary data. And when you get, because it's never usually about one data point. Had Friday's unemployment report happened 2 months ago, 3 months ago, you would not have seen the same negative reaction that you did on Friday. But when you start to put together these strings of trends in economic data, this is when the market starts to take notice and be like, oh, is this something actually? Right? Because they'll ignore one data point, 2 data points, 3 data points. They'll ignore those all the time. But when you get these trends, and I think that's what's happened over the last couple months, Matt, is that you've had just this, oh, we had an ISM services a couple months ago come in really hot. And oh, we had a PPI and a CPI report show a little sticky. Oh, we had this and that. And then when you get to Friday and it's like, oh, jobs really beat. Unemployment rate went down. It just kind of was that proverbial pile on to this storyline.
The market is, there's arguments that the market makes for lowering inflation all the time. One of those arguments that the market makes is if the economy deteriorates just a little bit, that's going to really help on the inflationary side of the equation. The economy is not deteriorating here. And it's not, in my estimation, it's not going to deteriorate in 2025 either. There is way too much money in our economic system right now to see that ultimately occur, in my estimation. And so when you're looking at this economic data coming in, it's not like we're dealing with the robust economic data of the 1990s right now. It's not that. But Mark, small beats, small beats, small beats, small beats, small beats, small beats. And then when you get your more important numbers coming into the market, like on Friday's labor market number, which is not just it's probably the number one most important economic report, even today, you get that number and it comes in at 256,000 against an expectation of 164,000. And the unemployment rate, which is not the vital part of this equation, but it's a really important headline number, is reduced from 4.2% to 4.1%. That's a good economic report. And good economic data has a tendency to do 2 things. Number one, increase the value of the United States dollar and thus increase the interest rate as well. And so when you're looking at that good economic data, I don't think we should paint this as a negative. It's good to have good economic data, but it's also equally important to understand that there is environments that we go through called good news is bad news, and that we are firmly entrenched in one right now, given the fact that until the market stops laser focusing on the dollar, laser focusing on the yield side of the equation, this market's going to feel a little bit volatile and it's going to feel a little bit uncertain. But again, to me, it's
Yeah, now, Matt, you're taking the bull side of the equation here in a minute. You're presenting some of my bearish arguments, right?
well, it's not an easy one, right? There is an argument to be made here, and that's why I think it's important to have the conversations.
Which is why we're doing this segment. All right, we're going to get into that in just 1 minute. I just want to look ahead at the week ahead coming up because we've had, set the stage. We've had all of this, stickier inflation, rising yields, rising dollar. And Matt, cumulatively between the economic calendar and the earnings calendar, this is a very sneaky big week coming up, isn't it?
Yeah, it's a vital week, and I'll let you talk.
Sitting got support coming in with all this stuff.
Support with massive potential themes developing this week. Number one, the number one concern in the market right now is double dip inflation, correct?
Yes.
I don't think there is second.
No, because if you take out if you add and this is what, if you add the inflationary argument to a rising yield conversation, because the rising yields is not just being driven by inflation expectations, it's part of it. But if you add that in, you're capped out in equities for a while.
Yeah. So in terms of the economic side of the equation, yeah, you got a lot this week. But and I do think the most important part of this week is the CPI report. I think that's by far the most important part. You have the forecast that came into 2.9%. So we are expecting 2.9%, which the previous number was 2.7%. All of a sudden, that already puts up my spidey senses on the headline number. Already, Mark. Remember, there was a couple months ago I made the call.
Talk about that for a second.
Well, think about it. There was a couple months ago I made the call that based on the expectation, the market is going to go up on the CPI day based on the fact that the most likely scenario is even if you come in at a miss, it still is better than the year over year from last month. It's still better from the month over month from last month. I think you can make a little bit of an opposite argument here where you had 2.7% last month. Everybody's concerned about inflation. Not everybody understands how inflation actually works, though. They just hear the headline numbers, and all of a sudden, I guarantee you, those headlines are already written, Mark, before the data even comes out. Inflation goes up. Inflation elevates. Even if by totality of market standards, it comes in at 2.9%, 2.8%, technically a miss, the headline's still going to read inflation goes up. And so people aren't going to go in and look at the nitty-gritty detail of all of this. They're just going to see that headline number and be like, oh, inflation is still a problem. And so it's kind of set the stage to be a concern this week. But then again, we've already priced in a little bit of that concern. So the expectation is coming in at 2.9%. Outside of the inflationary data this week, to me, the most important part of the economic data this week is not even economic data or the information coming into the market. Market has to be, when you're looking at the market this coming week, it has to be on the earnings side of the equation. Earnings season is kicking off on Wednesday. Now, on Wednesday, Mark, you get Bank of America, not Bank of America, but you get the traditional kickstart to earnings season. You get JP Morgan, Citibank, BlackRock. You get those big money center banks reporting earnings. Then on Thursday, you get Goldman Sachs, Bank of America. But unlike most kickstarts to earnings season, it's just that. You get 8-9 companies. They're all on the bank side, plus Delta Airlines, plus United Health. That's kind of the traditional kickstart to earnings. This week, however, it's not just that, Mark. When you pointed this out to me on Friday, because I normally do my look ahead on Friday and start that. When you pointed this out, I was like, oh, that's interesting. The most important company reporting earnings next week is Taiwan Semiconductor by a mile. By a billion miles. These banks, I'm going to write you the headline already. These banks are going to absolutely crush earnings. These banks are going to destroy earnings. These banks are going to make technology earnings look like a playpen. It's going to be beautiful on the year over year numbers. Now, that does not mean price is going to skyrocket, Mark. The expectation is 35% on blended growth for the financial space. They came from a really low point last year. And so it's kind of one of those. Do you remember the year after the pandemic hit, the massive growth numbers we were reporting on?
Yep.
Do you remember that?
Oh, well, that was massive. Yeah.
Just that these companies were doing 90% revenue growth year over year. It's that the economy shut down, and then a year later it was opened up, and you went from zero to these expansive numbers. The market didn't care. The market saw those numbers coming in. They're like, oh wow, boom, up. And so finance is going to be a winner this quarter from an overall fundamental perspective. The technicals, the price response, all of that's going to be important, because that what I just said is very well known to Wall Street, quite frankly. That is already priced in. That's why the banks have held up better than other cyclical areas of the market. However, quietly, Taiwan Semiconductor, one of the catalyst stocks in the AI side of the equation, which usually reports in week 2 in earnings season, is getting the leadoff role here. Themes have developed from Taiwan Semiconductor, and it's not just Taiwan Semiconductor. One of the catalyst stocks in energy is also reporting earnings this week, Schlumberger. So it's not just the fact that you have 20 companies, which is not a lot of companies reporting earnings next week. It's the types of names that are included in the kickstart to earnings. And quite frankly, Mark, I think the market is going to take its cues ultimately from the earnings backdrop. But I do believe the market this specific week will be more sensitive to the economic data. I just have a tendency to believe that the next leg in the market is going to be driven from an earnings perspective.
Let's talk about these bull versus bear cases now, Matt. And I'll lead off. And let's just have a discussion. I'm sure I have some points. You have some points, and if you have any discussion points, because this is not meant to be a debate, Lincoln Douglas style college debate rules to see who wins.
I was ready to take up Lincoln's role in that one. You can be Douglas, I'll be Lincoln. That's fine. Or I could be JFK and you could be Nixon. Like we could do that one. You want to do a Dan Quayle? Can we do a Dan Quayle?
See, you're a jerk. There is my opening bear argument. All right.
Dude, but if you go back 20, 30, 40, 50, 150 years of American history, you don't offend anybody on those types of things. So
I
offended you, but
you offended me.
Yeah, you'll just yell at me later.
All right. So bear case, and so I'm going to, talk about some of the things on the bearish side, because markets are having genuine.
Are you just going to make a bear case, or are you going to bear porn this up?
No, I don't have enough to bear porn it. And if you don't know, that's a little tackleism on bear porn, is when there is we're just going to drop all of the things that theoretically
here's
could
the
go
bearish
wrong.
Nukes to the market.
Here's all of the bearish arguments that there ever are out there right now. No, I mean, these
2022 was bear porn environment.
And so it's and so these
even more than
ones,
2020. Anyway, sorry. I'm sorry. Go ahead.
When I look at bearish conditions and the bearish conditions that scare me, I don't think the next pandemic will create a bear market. I don't.
Not a chance in the world. The next pandemic.
Not a chance.
We'll throw so much money at the problem,
and the market knows that that's what's going to happen,
and we won't shut down the economy the same way.
So just like we saw the banking crisis that we had in March of 2023 didn't cause really bearish conditions. Market traded sideways, a little bit of drama for a couple of days. Right. And it was over, because markets know that it is Fed policy. It is the flow of money that has become modern markets. And so when we have things to disrupt that is right where I start off on concerns. Right. We've talked about in this podcast and in Tackle Trading Program and all of the market. We were before these conversations. The market is now, conversed in them. Like Morgan Stanley this week warning that, hey, rising yields could pose a headwind to stocks. Thank you, Morgan Stanley. Join the conversation with us 6-7 weeks ago, right? Join that conversation. But rising yields, as long as the dollar and yields charts keep going up, that is by itself all I need to make the central piece of a bearish argument. Uh, Rising yields, rising dollars. We have seen it in the summer of 2023. We have seen it in other periods in market history. No bueno for risk assets. Generally takes everything down with it. Some things fight at the start. Sometimes, certain commodities will fight, and sometimes big mega cap tech in 2023 held on, but eventually it cracks everything. Jim Bianco has a fantastic comment that I read a few weeks ago, and it says the stock, gold, alternatives, and crypto markets cannot destroy the bond market, but the bond market can destroy all of them.
The bond market, I don't think people understand how big the bond market.
Like this thing is a record, and it
billion every day, bro.
And it plays on multiple levels. It affects banks' balance sheets with treasuries, which is kind of was the cause of the 2023 banking crisis. Affects borrowing costs, affects profitability of companies, right? And there is just a point where the weight of it just cracks on traders, cracks on investors, cracks on algos. And, it's very, very, very concerning. Anything to add on that particular point before I move on?
No, I mean, the dollar is a very big concern right now. I think it's the number one concern. The dollar is going up because of a couple different reasons. Strong economic data is putting pressure on inflation, and obviously the Fed coming off their aggressive interest rate cutting cycle is certainly putting pressure on the dollar here as well. But Mark, you also have other things happening that are not specific to the United States happening as well. And so a lot of times we just live in the bubble of the United States when we're looking at US equities. But when you're looking at the US dollar, you got to think about the pain train the US dollar is putting on a lot of currencies out there. And it's starting to get to the point where certain currencies might break, like break economic systems is what I'm talking about.
And you cannot discount the contagion effect, because if you have economic markets in one corner of the globe start to crack,
can I ask you a question on this?
Yeah, of course, man.
So it's a little bit of a political question, but I do think it's important. Do you recall about a month ago when somebody asked Donald Trump a question, President-elect Trump, regarding what the BRIC countries are doing regarding
I remember this
currency? And for the first time in many, 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 many years, you had a president of the United States come out strongly talk about the good luck moving away from the dollar's reserve, guys.
Yeah, no, and this is an important.
Like, I never heard Obama talk about it.
Well,
I didn't hear Trump really talk about it.
No, in fact, and I'm probably going to offend some Trump listener here, and I don't mean to, but Trump was very illiterate when it came to high-level economic things in his first few weeks in office, right? He's played catch up, and he speaks a much different game now.
Well, but in those, I don't think you're offending Trump fans there, because I'll tell you, I think it's very well known in his first go around that he was not ready for the political arguments that needed to be made.
Yeah, it's not insulting because
businessman, and all you do is control your center of the universe. And now you come into this massive bureaucracy known as the United States government. I don't care who you are. It's going to be very, very, very.
I mean, I remember, and this was in the early weeks of the first.
That ain't him this second go around, by the way.
Yeah, and it's not him the second go around. But in the early weeks of Trump, somebody asked him about what he wanted with the dollar, and he's like, "I want a strong dollar," and he immediately walked that back because somebody had obviously said, "No, we do not want that in this current environment," and he backed off that like immediately because somebody explained the economy and all of that about it, and he was like, "Oh no, you're right. We don't want that." Right. That was not what we saw. And that's a great point that you made, is that he came out and said, nope, he fought for the dollar. And I can't remember.
I'll tell you, I loved it. I loved it. Because
when's the last president you saw fight for the dollar? Because I do not have a memory.
Reagan.
Like, it has been that long. And so,
Reagan.
Now, so that dollar, I mean, these charts.
I mean, don't get me wrong. I'm sure Bush and Clinton and I'm sure there was some of that there. Just off the top of my head, I can't remember a president outside of Reagan that had an understanding of the foreign reserve and how important it was. And I do think that's playing a little bit of a role here, Mark, because, and we need to fight that, by the way. Like, we lose reserve status, I don't think people want to see the end result of losing.
You don't want to see, no.
I think inflation in the last 4 years was bad. Try quadrupling that by 100 times.
Yeah, absolutely. But, along with, something you mentioned in the newsletter is the don't fight the Fed.
Mm-hmm.
The Fed is turning crabby. Like we have had a very accommodative Fed, and this is once again modern markets 101, right? When the Fed does something, when the Fed turns crabby in 2022, that's all you should have needed to say, I'm done from the bullish side, go tactically bearish. And like that alone, just that simple 1-to-1 equation. Fed turns crabby, I'm going to turn tactically bearish, or at least cautious, right? That would have been good. I mean, the Fed isn't turning crabby like 2022 yet. Don't make me wrong. They're not full-on crabby hockey.
I think is extremely important in this debate, though, because
they are turning crabby. Michelle Bowman on Friday, that was lost in some of the noise, basically came out and said, we're done. We're done hiking. I mean, we're done cutting. We're done, right? And that is going to increasingly become a underpinning debate amongst all. Now, nobody's talked about hiking yet. And Jay Powell, outside of Goolsbee, is still a pretty dovish cheerleader overall. But you certainly you've had 2 dissents in a row, Matt, on a Fed rate hike. That hasn't happened in forever. You're hearing people like Bowman saying, yeah, I was this close to not supporting, right? And I won't support future cuts in the coming months. So you're seeing
they should not have cut last time. It was ridiculous. They did not have the data. They basically had already told the market, and the market doesn't care anyways because the market's smarter than the Fed.
And so we got a crabby Fed, we got rising yields, that alone, and once again, and so everything else I'm about to say is secondary to these 2 points, right? So like when I look at the bearish case, yields dollar, crabby Fed, everything else falls down the list by a pretty sizable gap. I do think the uncertainty around Trump is going to add. I saw, Senator Mullen from Oklahoma say that he expects Trump to sign 100 executive.
Mark Wayne Mullen, please.
He likes
it. He likes the Mark Wayne.
Well, dude, as a Mark Twain, I can appreciate that. I can appreciate a Mark Wayne.
We got some Mark Twains in our family.
My middle name's Twain, Mark Twain, right? So Mark Wayne. So Mark Wayne Mullen, right, says he expects over 100 executive orders to occur immediately once Trump takes office. Mm-hmm. Some of those orders, that's a lot for the market to
over 100 with 97 of them on immigration.
Listen, on the prediction podcast, I predicted a higher stock market in 2025. I still believe that is going to occur. That does not mean that in the short term, it could get really, really add uncertainty to a yields, right? So you got the uncertainty around some of these tariffs.
We could have a volatility pocket literally on Monday or Tuesday. Yeah, there is uncertainty.
You got, and then some other things, rising commodity charts. I did not like NVIDIA's price action on that candle this week. I didn't like that you didn't hold the 20 weekly. VIX seasonality kicks in. And all of this is coming from a valuation standpoint that's pretty elevated, right? That's pretty elevated.
I heard some news that a lot of people on NVIDIA, because that NVIDIA's price chart and what you were talking about, let's just make sure that people understand it. They officially hit all-time high price action. It was all over the news. 3 days later, they are significantly underneath that.
That candle, I remember meeting with
that's a rejection candle. Yeah.
I met with tackle trading members in Discord, which I do it for my casual Vikings, but any pro member is welcome to join. And I said, that's the ugliest candle I've seen in a year, maybe 2 years. I hated that candle on NVIDIA, just hated it.
NVIDIA has a little bit of a problem on their gaming semiconductor side of the equation. They're putting a lot of emphasis on their AI, and it does look like their non-AI development is taking a back seat, both in R&D and quality.
All right, and so that pretty much summarizes. I think a lot of the, not just mine, but market, right? Yields, Fed, crabby. Other things add to the list after those 2 standpoints. So that there's some of my bearish arguments for our little feature segment.
And I love the conversation because there is some legitimate concern whether or not we're going to repeat 2022 with the inflationary side of the equation in 2025, or whether or not this is just a double dip situation that we went through. If you'll remember back, when was it, coming into 2023, when you had that, there was a couple months of inflationary concern in the market where the PPI report had stopped showing improvement, and you had the CPI report for 2 consecutive months go up. And that was after a pretty long battle against that. And all of a sudden you started having this double dip inflationary conversation. And it ultimately got resolved, but I think you're having a very similar conversation now. Inflation is obviously a concern right now. It's impacting the dollar, impacting the marketplace and whatnot. But I guess from my perspective, taking the bull side of the argument here, I think at the end of the day, Mark, when you're looking at the S&P 500, if the only thing I was looking at was the S&P 500, I would probably agree with everything you said, and I would probably say, well, look for a leg down here, right? That's where my head was at. If we were having this conversation 10 years ago, I would agree with you for almost every aspect of what you said, and I would say that the market would probably be right there with you. But the market has changed post-pandemic, and it's not the same market. This is not the grandfather's market. This isn't your father's market. This is not your and my market that we grew up in 15 years ago. You have vastly. Tell me an environment in human history outside of the last 3 years where technology stocks were seen as safe havens in time of economic crisis to the market.
Now, we pointed this fact out in early 2023. As the banking crisis was coming on, I honestly believe we were the first people in the world, at least that I saw or read,
call tech as safe haven.
That called tech a safe haven.
Yeah.
That it is being treated as a safe haven
than any defensive instrument out there not named gold. And so when I'm looking at the market, the S&P 500 right here, what you're really looking at is a collection of 500 stocks, no doubt about that. But 500 stocks heavily influenced by the top 7-8 stocks in the world. And so you have a weighted index that is reflecting far more of the growth side of the market than what the real market is. And so when you look at the real market and you talk about the RSP, the diamonds, when you talk about those areas of the market, but in this instance, RSP, which is the equal weighted, you're looking at the exact same index, the exact same 500 collection of stocks. RSP is already in some degree of correction, right? A correction in the market is typically about 10% drop in price. When you go from 188 down to 173, you're in that ballpark, Mark. I think you're what would 10% of 188 be? It'd be 18 points.
170.
You're at 170, and so 170 is right 3 points underneath the current price. You're right in that.
You are essentially in a 10% correction. Let's just call it what it is.
I would say IWM is already there. I'd say many areas of the market are already there. And so the market is already in a correction. And so for me, this conversation we're having right now is really about understanding where the bottom is going to form. And that's where, and don't get me wrong, I'm right there with you in the ultimate short term this week. I have concern this week. I think the bears have control going into the week, and I think the bulls need a catalyst. I certainly do. But I think that's what the bulls are waiting on. I don't think the bulls are scared. I think the bulls are in a you first mentality right now and saying, well, we're waiting on a catalyst. Let's patiently wait. If we have to get a better price down lower, we'll do that. But I do believe we're already in that corrective territory, and I do not believe the corrective territory will eventually result into a bear market. Because, Mark, if you're right, then, and we see another leg down, and you were making the bearish argument there, you'll see another 10% downward pressure in price to get to that moment in time. And I just don't believe that's in the cards here. And the reason I don't believe that's in the cards, and the reason I believe that this is about finding a bottom in the market is because RSP, the diamonds, IWM, the cyclical areas of the market, or the S&P 500 RSP, which represents the entirety of the market from an equal weighted perspective, is already in some degree of correction territory. You're already near the 200-day moving average, for crying out loud. The 200-day moving average is often a zone that buyers and bulls will try to fight for. Our RSP is a point and a half away from the 200-day moving average. IWM kissed off the 200-day moving average on Friday. When you're looking at the diamonds, they're obviously a little bit elevated, but only about 8 points away from the 200-day moving average itself, which is only about, quite frankly, 2% from here. And so you're within 1 to 2.5% of that correction that is standardized in the marketplace. So I do believe this is about finding a bottom. And I believe that because from the bull side of the equation, Mark, I agree with you on the inflationary stuff. I'm very concerned about that. But what I'm not concerned about, and what I do think has to occur for the ultimate bear to actually have a bear market, is to have a rinse and repeat of the 22 situation. But I don't think you're going to get that. I don't think you're going to get that rinse and repeat to where you're talking about 8, 9, 10% inflation year over year. This is about understanding 3% sticky inflation and the amount of time the Fed is going to have to fight to bring that back down to 2%, which got expanded by a year in their latest dot plot and SEP. And so if you believe this is about finding a bottom, you have to base that on some degree of fundamental conviction, right? You have some degree of fundamental conviction. Well, let me give you some fundamental conviction here. The Atlanta GDP currently is 2.7%. The GDP is supposed to achieve north of 2.5% this year in 2025. Nobody's out there screaming recession out there, and rightly so.
Nope.
The data does not suggest it. Number two, when you look at the labor market right now, the labor market is a very big strength to the marketplace. You saw it on Friday, 256,000 jobs, destroyed the expectation. Labor's at 4.1%. This is after 3 years of the Fed fighting the labor market, and it is still at 4.1%. If you were to tell me labor would be at 4.1% after 3 years of the Fed fighting the labor market, I would say you're crazy, but yet here we are, 4.1% on the labor side of the equation. And so the labor side looks good right now. Inflation is obviously sticky right now. The other economic data from a consumer's perspective, I'm not seeing a lot of concern on the consumer right now. I'm not seeing consumers being tapped out post holiday sell season and so on and so forth. Yeah, it's tough. It's tough out there to live in America right now. There's no doubt about that. But that they ain't tapped out right now. They're still spending money out there. Consumer confidence is still fairly elevated right now. So from a totality of economics perspective, I just don't think you're staring down the barrel of that big old R word, Mark. I just don't see that to be in the cards in this iteration of the market conversation. And so economically, I think that's a winner for the market, quite frankly. That's why I think you're really about trying to find a bottom here. Number two, when you're looking at what really is going to drive the totality of this, of whether or not we find a bottom here or whether or not we see another leg down, I honestly think it's going to be from an earnings perspective. And when you look at earnings kickstarting this quarter, the banks are expected to achieve a 35% year-over-year growth percentage. Tell me, bring the bears all day long. Just bring them over all day long. Tell me how they're going to fight against a 35% growth out of the freaking banks. That is ridiculous. That's a communication and a technology number. By the way, communication and technology is supposed to be in the 20% growth side of the equation. In totality, the growth right now of EPS growth year over year is coming in at 11.7% going into earnings season. That 11.7% is the highest expectation we have had since the fourth quarter of 2020, first quarter reporting season of 2021. And so you got to go all the way back to the early pandemic recovery to look at the type of growth that is expected out of the S&P 500 in the fourth quarter of last year. Now, mind you, they ain't going to stay at 11.7%, Mark. More than likely, they're going to get around 15% on earnings growth. So you're going to tell me that the market, which has been puking up over the last 3 weeks based on the yield conversation, based on the dollar, that's going to continue to do exactly what it has been doing, because it needs to if it's going to see another lay down in the face of 15% growth. I don't believe that, because Mark, it's not all the time that the dollar is going to put this ultimate pressure on the market. Remember, it's only in these specific moments in time. And so from an economic perspective, I certainly think you're talking about a bullish condition right now. From an earnings perspective, I think we're setting ourselves up for some oversized price movements to the top side coming from an earnings perspective. Market's coming from a low point. Expectations are elevated, but the market's coming from a low point. That's an easy hurdle to overstep from an earnings perspective. So economic, I see that as a positive for the market finding a bottom here. From an earnings perspective, I see that as a positive in terms of finding a bottom here. Now, on that inflationary side of the equation, I get your concern that nobody's talking about higher interest rates right now. I don't think they can do that. I think Powell will resign before that occurs. Are you telling me that prideful Powell is going to pivot within months of lowering the interest rate to now embracing a higher interest rate? I think they would rather change the calculation of the CPI rate.
Yeah, and we talked about this in the Trading Justice podcast. Both of us see the dollar and yields lower, and this is, I know, simplistic analysis. I do believe in the Trump put. And it's the reason I believe in the Trump put is because I believed in the Yellen put. And the reason I believed in the Yellen put is I believe in the, unless they want the market to go down, which they did.
Trump thinks his report card is the scoreboard of the stock market, and that is a positive thing for the stock market.
That is a positive thing for the stock market, right? And so
when we had Baghdad Bob, Larry Kudlow, cheerleading the stock market for 3.5 straight years, the stock market usually did good when he came out and cheerleaded.
And he tried. And make no mistake, the first cast of characters around Trump are not as refined as the second cast of characters around Trump. I think you're not going to have Janet Yellen, because nobody's Janet Yellen, but you're going to have better than Mnuchin and Kudlow.
I don't think it could be that hard, honestly.
All right, listen, what I want to do the rest of the podcast, enjoyed that. Obviously, I side with the bullish argument. I do think that the correction and everything else, I do believe that
at the end of the day, you feel like this is a correction and it's about finding a market bottom. And even though that market bottom could take a little bit of time to digest.
And I love where you started with, because the fact that everything else is already deep into a correction might not be over, right? Might not be over. You might go all the way.
This was just the S&P 500 conversation. I'm buying puts and locking down risk graphs here.
Yeah, but because I already got materials in historically oversold conditions on daily charts. I already, have healthcare exhibiting a huge, massive bottom. I'm seeing things that scream bottom in certain sectors, not all, right? Not all.
Healthcare, energy,
and so could we?
Healthcare and energy.
And I do, and I am where the debate is I don't know what's going to happen this week. I don't know what's going to happen the coming weeks, but I am on bottoming pattern watch in certain sectors already. And that's usually has the tendency of filtering out.
Healthcare has been pricing in like the end of the world is happening over the last 3 months, and the healthcare space is not fundamentally a terrible place.
The healthcare already looks like it has went through not a correction, a bear market. And is trying to bottom near the 200-week.
Couldn't you make a similar argument for energy?
Yeah, no, energy, materials.
I know my argument in general is I don't feel we're going to have bear, because ultimately, if we do see the S&P come down, it will be based on the aggressive sectors coming down and the cyclicals and defensive.
And that could provide opportunities.
I think what we're ultimately talking about here is rotation.
Yep. I think that is the conversation to have. All right, what I want to do the rest of the podcast to get it within a timely manner, going to fire through some commodity charts, going to have 3 stocks in the news and a couple student questions, and we are going to fire it off. Matt, in the midst of all bear market, schmare market, commodities are like, let's party, right? We're seeing healthy price movement, and this is going to, and just insert here on every chart we're about to look for, we need to see confirmation. We need to see development. One surge does not a trend make. Can get encouraging, can get you on hyper pay attention to the coming pattern mark. But, that's kind of where we're at in a lot of commodities. But some healthy price action, Matt. While the market's selling off precious metals, copper, oil.
So what's telling the truth, gold or S&P on Friday? Because they both can't simultaneously be true.
Can they both be true? I think ultimately gold's telling
dollar gold up simultaneously while the market is down.
And this is complex because
it's complex.
You believe and I believe those two things cannot remain together indefinitely.
The dollar and gold, no.
And so you can see these, and you do see these one-day correlations.
They can correlate, but they're not 1,000%.
They're not trending together.
But they are not trending together.
They're not trending together. All right. And so I think ultimately,
I got a hot take.
All right. I want to hear it because I don't have a strong take here.
I believe we saw the end of the volatility on Friday.
That is a strong take.
I believe I think gold's telling a little bit more of the truth than the dollar is on this one.
So the one thing I do know on gold is if you don't have a massive red candle in the next couple of days, that breaks the pattern from the last couple of months, right? Yeah, the surge over, and then you just puked it all back immediately the last couple times you had a surge. If that doesn't occur, I'm going to become less defensive on the cash flow perspective of gold and more, try to sneak in some delta even.
On the delta side here on gold, I think you need to see development. It's a difficult instrument on the directional side of the equation. Now, don't get me wrong, it's a day that ends in Y, and we're going to be talking about sticky inflation for the next 5 to 10 years. So if you don't have a gold position, you should start building one. But at the end of the day, a lot of people at Tackle Trading already have gold positions. And so this is a matter of, are you adding, you reducing, you doing covered calls, you're looking to open up the risk graph. And when you're looking at gold itself, GC, or if you want to look at the ETF route, GLD, you see a lot of overall neutrality here. Now, what I would say that on the directional side of the equation, if you develop in a high base at 250, that could be a really good look. But the problem with anything that just breaks out with any proper pattern development, I would say, is you got overhead, and that overhead is not too far away from where the current price is. So I do think you would want to see some development, but that's on the trading side of the equation. I really liked what gold did on Friday in comparison to what the market did, in comparison to what the dollar did, obviously, speaking as a gold guy. When you're looking at GDX, I think you're talking a little bit of a different thing right now. I still believe covered is the way to go right now, but there's some scenarios where that changes this week, quite frankly. Whereas gold itself is really kind of, you break out at 250 on gold and you stare down the barrel at a very short porch to the next resistance level. When you're kind of looking at GDX here, GDX has always been a little bit more aggressive in its analysis than gold itself, obviously, as GDX takes its ultimate cues from the basic material space. Mark, you just said the basic material space is extremely oversold right now. And if you're value hunting, you're doing a little bit of that in basic materials. Now, I would suggest wait on bottoming formations, not just oversold conditions. But when you're looking at the area of basic materials that is actually doing fairly well in comparison to what materials is doing, that's the gold miners right now. You're sitting at the 200-day moving average, the 50 periods right there, the trend line's right there. Any developing pattern at 36.75 by 37, that looks really, really, really good. So gold wants to high base, GDX wants to do the same. I like GDX on the directional side. I like cash flow on gold.
Yeah, and we're going to look at silver, look at copper. Let's fire through these, and then we'll spend a couple extra seconds on crude oil.
Rinse and repeat silver.
Yeah.
Silver, silver's looking extremely similar to gold. The only thing I would say on silver is I think there's a lot of people looking at both of these two instruments right now. GDX coming from the low point, silver coming from the low point. Both have overhead, both have choppy conditions. Silver has a really good zone to start attracting pattern development, though, and that's at 28 level. Just keep an eye on 28. You break out at 28, that's probably a behavioral shift, getting it back. I would see that as a bullish trend Kickstarter right there as a breakout of 28.
Yeah, and give me Bitcoin real quick. I love the price action on Friday in that, there's been a lot of correlation between equity volatility and Bitcoin volatility.
Risk assets in general.
Yeah, and you fought back on Bitcoin. Had a positive day on Friday, despite quite a bit of volatility other places. Obviously, in a very tentative spot right now, right? One day does not make anything, but fought for a day. We'll see what happens next. One of those executive orders could deal with crypto, coming out of Trump. I think that might hold up Bitcoin in the short term. In the anticipation,
an executive order out of Trump should surprise absolutely nobody.
And so I think market knows that
an executive order on Bitcoin, I would be concerned.
Yeah, he'll be at 80,000 on Bitcoin if he doesn't
in a second, day one.
Like it is too anticipated at this point, right?
Priced in.
I don't know if it's priced in.
It's priced in.
I don't know about that.
Nonsense.
I don't know about that.
Okay.
I don't know about that.
Executive order, you can't do certain things with just an executive order. An executive order is priced in. It is.
Yeah, if it's just fluff.
Now, a Bitcoin reserve.
That's what I'm referring to.
Well, you can't executive order that.
Trump is going to try to do a lot of stuff that maybe you're not supposed to do.
I'm very familiar with how executive orders work, and that would get challenged in court, and they would win because that's a Congress duty.
Yeah. Well, we'll see if he gets it.
All Trump has to do is get the Republicans in Congress to do it. That's all he has to do.
Let's see if he can get into that one big bill he keeps wanting to do. Right? One big bill.
I can't imagine how big that bill is.
It's going to be a big bill.
It's going to be a big bill.
It's going to be a big bill.
I will tell you on the legislative process, I understand why the Tea Party Republicans, the MAGA Republicans, really want standalone bills. And I'm with them on that. I think a lot of pork and a lot of nonsense gets put into these reconciliation acts, these budgetary acts, and the debt acts, and they pile it all in together, and they hide a lot of pork in that, quite frankly. So I understand it, but I also understand it from Trump's side of the equation, and why Congress often does do one or two bills. It's hard to get things passed through Congress. It's really difficult, and so I understand it, but it'll be interesting to see those fights play out.
And then crude oil. If I didn't spend a lot of time on the bearish side on crude oil, but if this chart does not slow down, you're going to be able to add that to at some point the dollar yield conversation. This is just
where is that level for you?
Once again,
it's not 75 for me.
I stopped playing this game. I stopped playing the game a long time ago because I hear people play the game like Tom Lee, where he says yields don't matter until whatever, and I'm like, I just know at some point the trend, and we're not there yet, right? This is really, really early, right? This is a theoretical
From an economic
discussion.
Perspective. It's mid-90s,
but there is some point if this does not stop, and that's more of a month's conversation, not a day's conversation, where you look at the trend, and like if I look at yields, if I look at the dollar, it's obvious to everyone. The point, it's obvious to everyone. That's where it matters, right? And that's not right.
90.
And that's not.
I would say that's 90 for everybody.
Yeah,
I have a different opinion. I think it's 80. I think it's lower threshold than that. I think if you break out of 80, it's open season to 90, quite frankly.
And so we got a lot of macro charts in play.
By the way, this crude oil chart should get everybody a little bit interested in those energy stocks.
Yes, absolutely. Listen, gonna fire through a couple stocks in the news. Give me IONQ. My first stock story gives me a chance to talk about NVIDIA, Matt. We saw, it was a big news week out of NVIDIA in general. Jensen Wang spoke at the CES convention, had lots of things to say about NVIDIA. It's generally positive reviewed. I saw a lot of generally on NVIDIA specifically, a lot of positive, feedback, products. And NVIDIA is a great company. They're very well ran, all of that good stuff. Price action was funky.
CEOs in the world.
Yeah, price action was funky. Well, one of the things that Jensen said along the way is that, he did not think quantum computers were.
He said 30 years out.
We're coming within a reasonable time period.
Listen,
now,
we're not getting quantum computers for Christmas, guys.
Basically, and so and it wasn't just the because you saw stocks like IonQ.
By the way, nothing in my AI build out projections have anything to do with quantum computing.
You don't see 55-60% intraday clips very often in stocks, and you saw that in quantum computing. They settled in somewhere between 30 and 40% down that day. But it wasn't just, it was somebody well respected, Jensen Wang, very well respected, obviously, universally by the market, not just saying that it's going to be a minute, that it's going to be
the
half a life.
Generations are going to be about 10 to 15 years from now. And then ultimately, you probably won't see quantum computing until about 20 to 30 years.
And, and there's been some pushback from people in the industry on that after, but needless to say, this was a big, proverbial turd in the punch bowl.
I think he was
quantum
computer conservative in his projections because he's been criticized on some other areas. I think he was being very conservative, though.
Yeah, and so that was my first. Next one, Delta Airlines.
By the way, I disagree with him. I think quantum computing will become a thing before 25, 30 years. Yes, absolutely.
Speed of technology, betting against it has not been a smart thing in the last 10, 15, 20,
I think
30
if
years.
you were to ask Jensen 5 years ago if they would have been currently where they are today on the AI development a year to two from AGI, he would have said no.
Well, those alien drones circling around, they're dropping new technology for people, so I'll buy the argument that they'll be faster. Delta Airlines, my next stock in the news. Reminder, earnings season is technically already underway if it's not officially underway. Starting to report, starting to get companies. Matt, this is one that you had quite a few nice things to say about. Tackle 25, Delta Airlines.
Yeah, we had a couple Tackle 25 stocks report earnings last week. Delta ACI was another one. Both of them were, I did the good, the bad, and the ugly edition of earnings in the newsletter this week, and both Delta and Albertsons made the good list. Delta pulled off the hat trick, beat a pretty decent beat on EPS. Revenue was good, but it was really a guidance conversation. They increased forward-looking guidance, and I mean, when you're looking at the airlines in totality, Jets is breaking out at 26. That looks really, really, really good from a pure technical perspective. You look at that on a weekly chart, that looks really, really good. You got to go out to a little bit more time frame to understand kind of the developing situation. And Jets looks like it wants to get into 28 before it gets into any type of stubbornness from a technical perspective. But if you're looking at any one of these airlines that accompany Jets, it's Delta, and there is a mile between Delta and the other next highest quality airline company. Delta's 3 years in a row on the Tackle 25. It's most likely going to be 4 years in a row next year, as they've just kind of stood alone in terms of quality of what they do versus what almost every other airline has done. I've loved Delta for 15 years, both as love their stock in a variety of different ways, but I've also flown damn near 1 million miles on Delta jets over the course of that time frame. And I'll tell you right now, I if I had my druthers and if I had my choice, I would not fly anybody else besides Delta. There's a world of difference in quality.
There's a reason Matt goes through an extensive process in the Tackle 25, something we've talked about a lot. Not a bad time to become a pro member.
There was not a close second to Delta.
not a bad time to go check out that Tackle 25 list. Recently minted Tackle 25 list. Final stock in the news in an abbreviated
By the way,
version.
next this Tuesday in the Coach Show is round 2 of the Tackle 25 discussion with the pros. We had a great time last.
Look at that natural ease pitch that just right there in sync, right? I love it. That's a professional at work right there. Constellation Brands, ticker symbol STZ. A reminder as we head into this earnings season. Earnings season is going to have some ups, going to have some downs. In volatile times in the market, right, you're going to have both, right? You're going to have big, huge beats. You're going to have misses. Be careful. Be aware of the trades that you have on when they have earnings. They missed, Matt. It wasn't pretty either.
Yeah, anybody can see that one.
No.
They didn't just miss, though. There's two things that happened on Constellation this week. Number one happened even before the earnings event when the FDA came out and basically stated that liquor companies are going to have to start putting cancer warnings on their labeling, similar to what they made cigarette companies do, decades ago, obviously. That happened before STZ, Constellation, one of the bigger liquor companies in the market, before they came out and reported a miss on EPS, a miss on revenue, and then they lowered guidance. So not only did they get some negative news in front of their earnings, they decided to puke it all up on their earnings. This was a terrible earnings report coming out of Constellation Brands. The gap in selling behavior was to be understood, but it's even far more radical than what you typically see on a miss and a miss like you did on STZ. It was the combination of both those gut punches that was just too much for the investors to handle. This is a free fall situation. Catching a falling knife is not recommended, obviously. I would certainly categorize this as a catastrophic gapping type situation where it takes a lot of time to develop, bottom out. You got to work off a lot of things there, and the smell is the first thing you got to work off. That's nasty.
Yeah, we need a beer after that candle. That is quite the weekly.
Good thing for STZ, they have a lot harder stuff.
All right, finish up a couple questions. Matt, from a student.
Coach's Corner? Is that what we're doing?
Coach's Corner. We're going to do a little Coach's Corner, finish up our podcast. From a student. And if you ever have any questions, right? Well, become a pro member, Trade the Lounge. I write down every question we have, draw from some of those. Or you can email me at team@Tackle Trading. Whether you're a pro member or not, email in that question, and don't be surprised if at a minimum
30 to 45 minutes every single day in our lounge, at the end of the lounge, just answering students' questions on any education, any trade management, technical condition, fundamental. We get the gambit and we love it.
Yeah, I know. And at a minimum, your question, if you email it into Team of Tackle Trading, will be answered. And don't be surprised if it's featured. Matt, from a student, I've heard you say a few times now, year of the cash flow in 2025. What do you mean by that?
Well, I think we're seeing a little bit at the beginning of this year of what I mean by that. I think we're going to finish the year up 10, 13% is kind of what I think. But the path of getting there is going to be 2, maybe 3 legs total. I think you're going to see downward pressure on price this year. I think you're going to see wide range neutrality this year as the market gets accustomed to some of Trump's policies, and specifically on the tariff side of the equation. The tariffs, the market's not going to celebrate tariffs. And no, I do not believe we're going to ultimately do a general tariff conversation. But even outside of that concern of the market getting used to that conversation, or the market getting used to the double dip inflationary conversation, or the market having a constant debate over earnings or the economy, over the post-pandemic recovery, whatever the case might be, I just think that I came into tackle trading this year wanting to really get our community to embrace the compounding impact of cash flow. And so it really, the theme that I chose this year for tackle really wasn't necessarily about what I personally felt for the market coming into the future. It really wasn't about, oh, you got to look out for the economy this year. There was no hidden messages there. There wasn't. There was a billion conversations we had last year, and people trying to understand and learn what the power of compounding and cash flow was all about, to the point where I just came into this year saying, all right, guys, regardless of where you're at, regardless of your account size, regardless of where you're starting, regardless of your experience, regardless of whatever you're doing, this is the year of cash flow. And what we're going to do is we're going to focus on that in our program. Like, we're going to focus on that in our educational webinars, and we're going to force the issue with our community. Quite frankly, it started with the Tackle 25. We've done 4 different webinars in the last 2 weeks with our pro members and non-pro members regarding the Tackle 25, but it's going to continue throughout all year long. As we do more and more education, more and more webinars on cash flowing in the market, covered calls, naked puts, boomerangs, credit spreads, whatever the case might be, in getting our community to embrace cash flow. Because if you can, direction becomes a little bit easier when you have cash flow with it. You know what I mean? And so I just think it was more about me wanting our entire community to start embracing the cash flow compound impact. Because whether or not you're with us for 6 months, a year, or 10 years, like some of our students are, there's no better time than right now to start the compounding impact of cash flow. And so it was more just something I personally wanted our community to really start embracing. Because sometimes I feel like all of us, not just in our community, but all of us, just human beings, good intentions don't always impact good results. And so I wanted to make sure that our community knew exactly what our focus was, and it's our job to help them accomplish that. So that was more that it was more about creating a theme to get people to get encouraged to embrace cash flow, regardless if the market went up 7, 8, 9, 10% this year, regardless if the market went down 7, 8, 9, 10% this year. Because if you embrace cash flow, it allows you to navigate the financial world much, much easier. People get busted out of the market all the time, Mark. They usually don't get busted out because of cash flow. They usually get busted out of the market because of delta and because they get too aggressive on the directional positioning.
Yeah, it's very true, very true. Speaking of cash flow, Ted covered call questions both in the lounge. We've had the Tackle 25.
There's been a lot of covered call questions.
We've had a lot of covered call questions. Another one, a different variation. Not that we did on a cover, and I understand this question completely because of the market we're in and the emphasis we've had in our community on covered calls recently. On a covered call, when should you sell an in the money covered call?
When the market just violated a support level.
Or your individual stock. Yeah, in fact, give me Caterpillar as an example.
I was meaning the stock, the market. Like, I wasn't meaning the S&P broke support. I was meaning the market, like your stock.
Your stock, yeah. No, I mean, I think.
Yeah, when the market breaks an important support level, you're going to want to be a little bit more aggressive on the covered call. When you break the support level in combination with the sector doing it, you're going to want to be a little bit more aggressive. Usually we get more aggressive in bearish downtrends, and thus the beginning point of a bearish downtrend is a breakdown. And so it's always in bearish conditions. Always. We usually don't choke off covered calls in neutral or bullish conditions. We want to be more conservative on deltas we're selling. But in a condition where you're violating a support level, for example, like Caterpillar, you would in essence want to do an in the money, because volatility explodes. You're able to sell that in the money or at the money call option, bring in a tremendous amount of cash flow. And then as the market goes down, there's nothing intrinsic on that. It was all just nonsensical volatility that comes out of the option pretty quickly, quite frankly, based not just on time, but when volatility declines. Volatility usually doesn't show increase nonstop, right? You get these volatility punches, and then it typically does slow down after that. So it's always in bearish conditions, though. A bear retracement coming into the last bastion of resistance in the depth of the retracement conversation, you want to be aggressive there. On a bear breakdown, you want to be aggressive there.
Okay, final question. Indicator related. You talk about indicators in the newsletter all the time. Question is, if you could only use 1 or 2 indicators, which would you choose? I find myself getting overwhelmed with the indicator conversation at times.
I try to keep it light on the indicator side of the equation. I talk about traditional indicators in the newsletter. I don't introduce too many craziness because I'm not an indicator trader. I'm a price action trader. I use indicators to help me confirm what I'm seeing on the chart. And so, like, for example, I think MACD is a wonderful indicator to help you understand the momentum of the condition. I think RSI is a wonderful indicator to help you understand overvalued, oversold conditions, where you want to be a little bit more cautious. But the number one indicators I use are price action. Quite frankly, my favorite chart is a clean chart. There's no doubt about that. The cleaner, the better. I love making decisions based on natural price action, understanding candles, support, resistance, trends, pattern development, all that jazz. Outside of that, to a traditional indicator side, I would say moving averages are by far the best indicators out there for areas where you expect support or resistance to develop, crossovers, momentum, you name it, moving averages. There's so many things you can do with moving averages. I mean, every single indicator that we talk about uses some degree of moving average, for example. So if I could only use one, I would perfect moving averages. If I could only use one indicator outside of natural price action.
All right, listen, let's wrap it up, bro. Enjoyed the podcast. Lincoln won, but Douglas threw the debate. So send us out, close us up.
Is that what Nixon said?
Yeah.
I think
if you give me that damn Nixon JFK analogy one more time, I swear to God, I don't know what I'm gonna do, but it will be something.
You're gonna threaten me on the pod a couple more times.
I am.
Oh, goodness gracious. Tackle Trading, thank you so much for being the best part of our community. Without you guys, we are nothing. And hope you enjoyed another edition of the Trading Justice podcast. If you did, hit that like and share. That's the best way to help us out with the Trading Justice pod. And if you are ready to become a member of the Tackle Trading community, there is no time better than the present. You can go over there to tackletrading.com, sign up for a free 15-day trial. And in that 15 days, you can get access to the newsletter, the traders report. You can get access to 12 different traders lounges, 4 different coaches shows. You can get access to both the on demand for Master Trader, and you can attend live the upcoming Master Trader class, our amazing class we teach live every single month at the end of this month in January. You get all of that for absolutely free. The best value there is, and if you don't like it, you don't have to stick. If you do love it, you'll stick with us long term. Come over to tackletrain.com, hit that free trial button, and let's have some fun.
Listen, have a great week, everyone.